Good afternoon, everybody. Oh, come on, come on. Good afternoon, everybody. One more time. All right, super. My name is Jim Mintert. I'm the director of the Purdue Center for Commercial Agriculture and also a professor of ag economics. And I want to introduce my colleagues, Dr. Brady Brewer, who's also a professor of ag economics at Purdue, and my colleague, Dr. Michael Langemeier, who's also a professor of ag economics and the associate director of the center. So we're going to spend a little bit of time this afternoon talking about our topic, which is positioning your farm for long-term success. And during the course of the afternoon, you'll have an opportunity to answer some questions that will allow us to make some comparisons between what you think versus what we found in a national survey. So the QR code at the bottom there, if you'd pull out your phone, this is one of those rare sessions where I'm going to ask you to use your phone. Pull out your phone, shoot that QR code, and that'll take you to the survey and give you a chance to respond to questions. And so I'm going to pause for a little bit and let you do that to kind of get you up to speed. And then there'll be several points during the session. We'll ask you to give a quick response to a question. So with that, I'm going to turn it to Brady to kind of kick this off a little bit.
Yeah, so gone are the days that university professors tell students to put your phone away. Now we tell you to take your phone out as an interactive tool. So you can scan the QR code, or if you notice at the top, you can say, go to minty.com, and then you can type in that code, and that's going to stay up there throughout. So if you have connection issues, but it should just be blank right now. And when we get to the questions, it'll automatically pop up on your screen. So as Jim said, we're going to be talking to you about positioning your farm for long-term success. And really what we want to think about is, how do you manage through strategic risks that your farm is going to face? I'm going to turn it over to my colleague, Dr. Michael Langemeier, to kind of set up what is a strategic risk.
Essentially, what we're talking about here is the risk of being out of position. Many farms have a competitive position strategy, either to being a low cost producer or a value added producer or something like that, and things happen. And things like government policy changes, geopolitical conflicts, disease, change the consumer preferences, changing weather patterns, all this stuff happens. And does it cause you to lose your competitive position? You fall behind others in the industry that may be reacting more appropriately to changes. And so we're trying to look at the internal resources and capabilities that we have and trying to respond to external forces.
Now, Michael, there's several different ways we can think about a farm responding to strategic risk, though, right?
Yes, there's two major buckets here, if you will, or strategies, things to think about. I'm going to start with the bottom one, absorption capacity. This is a farm's ability to withstand shocks from strategic risk. And so, do you have a strong balance sheet? We're going to be talking about that a little bit later. Do you have a strong balance sheet so that we have 2-3 years here of relatively low net returns, you can weather the storm? What if there's a big shock to consumer demand or something like that? Do you have a strong enough balance sheet to weather the storm? So that's kind of the absorption capacity. There's another side to strategic risk that's more on the upside. Does your farm have the ability to quickly identify and capture business opportunities as they arise? Are you in position to rent that additional 160 acres that may be coming up for rent in the next year? Are you in position to buy that 160 acres that may be coming up for sale in the near future? And so you want to talk about strategic risk, both from just being able to weather the storm, but also responding quickly to opportunities.
So Michael has told us some of the ways or what a strategic risk is. Now we're to the first interactive portion of the session. So I'm going to throw the QR code up again. If you haven't scanned it, if you've already scanned it, no need to do it again. But the first thing we're going to ask you is, what is the strategic risk you're most concerned about for your farm? So we're just going to go ahead and throw that up. And if you have multiple, it'll allow you to enter 3 of them. So we just want to know, what are the strategic risks that concerns you most on your farm? And while you guys are putting that in there, I do want to say the application that we're using, if you have questions, you also have the opportunity to ask us questions in the chat, and they'll come right up here to us and we can answer them either at that moment or, depending on timing, at the end of the session. So feel free to ask us questions in this application as well. We will also hopefully have time for a Q&A at the end. And there is a microphone there in the middle. So as you see, as you were entering, these are the strategic risks that people are entering, and you can enter up to 3 different options if there's multiple risks that you are concerned about for your farm. So Jim, I'm just going to pitch this first one to you as people are still entering. Commodity prices comes to the top with this group. Does that surprise you?
No, it doesn't, especially given what's happened to commodity prices these last couple of months. We've been experiencing a difficult time in both corn and soybean prices and even wheat prices as well. So, you see, think about commodity prices. One of the things you want to think about is what are you doing to manage commodity prices? What are you doing with respect to things like developing a marketing plan? Have you evaluated your performance from a marketing standpoint relative to peers? There's lots of ways to do that. One way would be to think about how your prices received, for example, for corn and soybeans compared to national average prices published by USDA. That's a starting point. You could also look at how your prices that you received on a net basis over the course of a year or for a crop year from your farm relative to some of the marketing advisory services. They publish some of that information. But the key point is to start thinking about how you might manage that going forward. What is your marketing plan? Do you have a marketing plan? Do you have storage? Are you doing a good job of maximizing the returns from storage? Have you been thinking about basis patterns in your area and how you might do a better job of capturing improvements in basis that typically occur during the storage season? And are you developing strategies that you can use year after year after year? And I guess I think about one of the things I'm doing right now is working with one of my students who's planning to go home to farm here at the end of the year after he graduates from Purdue. His senior thesis is working on developing a marketing plan using different strategies and actually developing a portfolio of strategies that he could use not from just a 1 year perspective, but from a long-term perspective over the course of his farming career. So think about some of those things as you think about commodity prices.
And it's, I think this next thing that comes up is interest rates. And Michael, you and I have talked a lot about interest rate risk and where we are currently in, what's happening with interest rate policy. It does not surprise me that we see interest rate rise to the top as well.
Not at all. In fact, in the Ag Economy Barometer, month after month, the 2 biggest concerns have been commodity prices and input costs. And of course, the interest rates is part of that input costs.
Yeah, and the one thing I am quick to remind people, interest rates, we've seen a pretty historic increase in terms of the rate at which interest rates have increased here over the past 1.5 to 2 years. But if you look at the Fed funds rate, we're right between 5.25% to 5.5% from the Fed funds rate. The 20-year average is right at 4.9%. So we're only about 25 to 50 basis points higher than kind of the long run average. So I would call the interest rate environment returning more to a normal environment. We are a little elevated. I don't want to pretend that we aren't in somewhat of an elevated environment, but we're just slightly above the long-term trend when it comes to interest rate. But with that said, if you think about the percentage of gross revenue for a farm that now goes to interest rate, it was historically low, and now it's going to come up pretty significantly on the income statement.
Another way to think about it, Brady, is the interest rate today is very similar to what it was in 2007 before the big recession we had in 2008.
So Brady, let's take a look and see what we found in our national survey.
Yeah, so before we do that, Jim, I want to set up what we're going to talk about in the national survey. And this is really just setting up how we're going to go through the rest of this presentation. So we're talking about strategic risk and positioning your farm for the long-term success. One of the things I'm a big proponent of is thinking about the strategic levers you can pull on your farm. And that's how we're going to organize the rest of this session, is thinking about what are some items that you can do within each of these strategic levers that can help you mitigate some of the strategic risks you may face. So the 5 levers you see up on the screen. So output price, yield, managing your costs, managing your assets, managing your people, painting with a broad brush. So broadly speaking, any decision you make on your farm is going to fall into one of these 5 broad buckets. If you're choosing a new piece of equipment, that's on the asset piece, but it also covers some of the other buckets as well, thinking about how that impacts maybe your variable or fixed costs, how that's going to impact your precision or your yield that you have, maybe your labor requirements that you have on your farm. So any decision you make on your farm is going to be categorized into one of these 5 buckets. So now we're going to start comparing your guys' answers with maybe these 5 strategic levers to what the national survey and the Ag Economy Barometer said. So this is slightly different than the 5 buckets you just saw. This was a slightly different version of those strategic levers where we add in legal and then we separate people into kind of the strategic arm of your farm. And then there's also the human side. So the question we want to ask is, which of the following risks would you say is most threatening to your organization? And you have 6 options up there. Is it the marketing? Is it legal, production, strategic, human? Which of these 6 broad buckets do you think is the most threatening to your organization? And we'll give you a few minutes here to get your answers in. I should say there is no correct answer here. We're just wanting to see how, with your management style of your farm, what do you feel is the biggest threat to your farm? So I guess, Michael and Jim, I will put you guys on the spot here. It looks like the majority of this audience, at least, is thinking that the financial risk of the farm is the biggest threat. Is this surprising to you?
Not at all. When you look at the 24 crop budgets, for example, I mean, it's a classic margin squeeze. The prices are lower and the costs are still relatively elevated. We've got a little bit of help from fertilizer costs, but cost of production are still very high, particularly compared to production costs before COVID.
And then the second bucket there is marketing. I think given some of the current commodity prices and the decrease in commodity prices, that's not surprising as well.
So it's not surprising, but one of the things that has been surprising on our surveys over the last 2 years really is the percentage of people who have been very worried about input cost, not just from a level standpoint, but from a standpoint of the variability that they've experienced with respect to those input prices. And it's really made people very nervous. I think it actually contributed to people having some relatively weak sentiment. So, but marketing, a very traditional concern. And in our most recent surveys, we've been picking that up as people becoming more worried about marketing, which is kind of a return to normality.
And then human is third. And this is not surprising to me. If you think about some of the news headlines that you've seen out there, there's definitely labor shortages, not just in agriculture, but the labor markets, broadly speaking. I do think that this probably hits certain sectors of the ag economy, maybe a little bit more than others, but it's not surprising to me that it is third. So let's go to what the national survey said. So pretty similar to the farms that you guys surveyed nationally. And maybe, Jim, I'll turn this one over to you. My first question is, could you tell the audience a little bit about what's the demographic? Who are we surveying with the Ag Economy Barometer?
Yeah, that's a good question. So every month, we survey as a part of our Ag Economy Barometer project, 400 people across the nation. And it's strategic with respect to the stratification of the survey. So it's targeted at people who are engaged in production agriculture as their primary source of income. The stratification we use is people who have an estimated gross farm income of $500,000 and up. And then it's also stratified with respect to the value of farm production based on the USDA Census of Ag. What that means is it's oriented fairly strongly towards people who produce corn and soybeans. Every month, at least 53% of the people in the survey have a corn or soybean enterprise. I think 19% have a beef enterprise. 16%, I think, have a wheat enterprise, and so on down the line. So we talk to people who raise corn, soybeans, wheat, and cotton on the crop side. And on the livestock side, we talk to people who are producing hogs, beef cattle, and dairy. So again, representative of the primary commodities. And, you know, when I look at the results, this survey was actually, these results we're showing you right here were conducted back in April. And so no big surprise, Michael, that financial was less of a concern then than it is today, right?
Yeah, that's certainly the case. I mean, 23 was, it was even back then, looked like it was going to be a better year than what 24 looks like right now.
And we were coming off a record
Very
farm
good
income in
years,
2021
and 22.
So we're seeing an evolution in terms of concerns. And I think a lot of you already recognize that we're in a tough environment for 24 and probably a tough environment for 25 as well.
Yeah, so definitely some timing differences for why we may see some differences in the answers of this audience relative to your national survey. So let's start going through the strategic levers that we can pull. So we're going to start with thinking about the marketing side and the output price lever that farmers can pull. So I just want to clarify here. So you should be able to slide on your phone to answer from 0 to 100. What we are asking you is what percent of farmers do you think evaluate their pricing plan? So if you think about the farmers you know in your area, so if it's 100, you would slide it all the way to the right. If you don't think any farmers in your area evaluate their pricing plan, you would slide it to the left and it would be right around, at 0. So what percentage of farmers that you know in your area do you think on a yearly basis evaluate the pricing plan they have for the crops that they grow? So it looks like right now, the audience is somewhere around the 40 to 50% mark. So Michael, I'll pitch this one to you first. Does this surprise you? Is this what you would have expected for this group, right around a little less than half of farmers?
I thought it might be a little bit lower, but one of the things I want to focus on here is look at the distribution. I think that's very remarkable, and that's true of the Ag Economy Barometer questions in general, Jim. We see a lot of differences in how people answer questions, relative optimism and pessimism, for example.
Yeah, so you've got, just so you know how to interpret the graph, those little mountains you see on there are essentially individual responses or small groups of responses. The average of all the responses right now is sitting at 46%. The 46% doesn't surprise me too much relative to what we saw in our national survey. But as Michael pointed out, the distribution is huge. And again, as we look at not only the Ag Economy Barometer surveys that we do every month, but also the other work we do with respect to things like the farm management tour, the workshops that we do, we continually discover a lot of diversity with respect to people's managerial ability and how much impact they're having on their operation with respect to some of that decision making. So Brady, go ahead and show the next. So when we did the national survey, 60% of the people said they actually document and evaluate their crop pricing performance. 40% said they don't. So we're going to say, if you haven't been doing this, if you're in the category that's not doing it, you should be doing it. One of the challenges you have, of course, is how do you do that? How do you make the comparisons? Well, I mentioned earlier, you can compare your performance relative to the market averages published by USDA. That's a first starting point. You can look at performance of various marketing services. And if you don't see those published, you could actually talk to some of those marketing services and they'll share some of their results with you. That's one way to compare it. But from the longer term perspective, really it helps you think about what kind of a marketing plan do I have, not just for this year, but from a long-term perspective. Can you identify an approach to marketing that helps you be more consistent over the course of the years? And the classic question to ask is your marketing plan basically one where you're trying to hit home runs all the time, right? Are you trying to decide, for example, in a particular year, I'm not going to sell in advance of harvest. I'm going to store almost 100% of the crop, or the next year, I'm going to move a large portion. The challenge with that is, and we've got lots of evidence of this, it's extremely difficult to forecast what's going to happen, right? And you've all been through that with respect to looking at various marketing newsletters, marketing advisors, whatever. This key to success is to recognize that it is difficult to forecast, and your plan has to admit that right up front and recognize the difficulty and start spreading out those sales based on long-term seasonal patterns, and then spreading it across marketing tools in terms of how you manage things like basis to improve returns to storage. So the idea, start off, do some comparisons, and use that as a launching pad to develop a marketing plan, not just from 1 year's perspective, but from a longer term perspective.
So that is the output price strategic lever. Now let's go more to the yield and production strategic lever. So if you think about managing how much you produce on your farm, and what we want to hone in on here is the diversification of your farm. So we want to ask, so what we're asking you is your farm enterprise more diversified today than it was 5 years ago? And you have 4 options. Do you strongly agree with that assessment? So this would say, yes, we are definitely more diversified with our farming operation today than we were 5 years ago. You could agree with it, be like, well, we maybe plant something different. You could disagree or you could strongly disagree as well.
So, Michael, as I think about this, diversification can be kind of a double-edged sword, right?
Yeah, there's no right answer to this, and let's talk a little bit about that, Jim. Diversification it has a couple possible benefits associated with diversification. I'll discuss that first, and then we'll talk about the potential problem with diversification. Well, first of all, diversification, particularly for smaller or mid-sized farms, is a good way to more fully utilize labor and capital. We've seen this all across the Great Plains and the Corn Belt. That's definitely the case for some farms. Also, think about a simple example. If you have a swine finishing and you have crops, you're lowering your fertilizer costs. And so there's things like that that are beneficial from diversification from a profitability standpoint. But the big benefit of diversification is reducing risk. That's why this question was in this survey. Is this is farms that are more diversified or more resilient in terms of their ability to respond or to react to shocks, and so that's why this question was in there. So that's kind of the upside of diversification. The downside is if you're more diversified, that means you might not be capturing the benefits associated with economies of scale. If you specialize, let's say you're a corn soybean producer with no livestock, and you focus on that, maybe you have lower per unit cost because you focused on corn and soybeans, and you're not focusing some of your resources on a swine enterprise, for example. And so, like I said, there's no right answer to this. There's positives and negatives associated with diversification.
So, Michael, when I think about corn and soybean production, I think most of us have focused on one aspect, right? And what is that?
I'm not
Scale.
Yeah, I'm not
right?
exactly sure what you're. Yeah, but
Scale.
certainly economies of scale. Yes.
Right. I mean, you could see that here at the show
Yeah.
with respect to the introduction of larger and larger equipment. I think our host mentioned that he's been coming to the show for 13 years. So think about the changes that have taken place with respect to scale economies, the size of equipment we're using today versus what was available 13 years ago. And I don't see that trend changing. The other thing that I think about as you think about diversification, Michael, is one of the things we work with a lot at the Center for Commercial Agriculture is people who are interested in bringing back the next generation of folks into their farm operation. And oftentimes the answer there is to think about bringing in a new enterprise and having that young person or young family take on that role of diversifying the farm by bringing in a new enterprise, right? So
Yes.
we've had some great examples of that in the last couple of years on the farm management tour that we conduct every year, right?
Yeah, swine finishing is the classic in Indiana, but on the last tour we had someone start a laying hen operation.
We also had a farm that had previously it had a small enterprise with respect to produce crops
Mhm.
and dramatically expanded that both from a production standpoint and also from a retail standpoint, and actually brought home several family
members.
as they expanded that operation. So think about diversification in terms of not only your ability to
Yeah.
improve agility and respond to downturns, et cetera, but also think about it as
Yeah.
a way to bring people back into the operation. So let's look at the national numbers.
Yeah, so here's the national numbers. It's almost the exact same number. So definitely some similarities between the national survey and what you guys here in this room are experiencing on your farms. The only thing I want to follow up on, so Michael, you mentioned that, the trade-offs is what I'm going to call it,
Mhm.
is that, when you think about the 5 strategic levers, anytime you pull one of them, they're all interconnected. So you really have to be cognizant of, okay, if I'm going to diversify, typically diversification means you're going to increase your fixed costs in some capacity and makes you a little less efficient, right? Because you're giving up those economies of scale that you're talking about. So you're gaining resiliency, but there is a cost to it. And that's going to be up to you guys to kind of think about that trade-off between how willing are you to give up some maybe efficiencies on your farm, but also bring in that resilience as well during the downtimes. So let's go on to our next lever, which is thinking about the fixed cost. So here, we're asking you to rate yourselves relative to some of your most efficient competitors. So think about some of the farms in your area that you would consider peer farms. Do you have low per unit fixed costs relative to your most efficient competitors? So do you agree with the statement? Do you strongly agree? Do you disagree? Do you strongly disagree? Okay. Where do you feel you fit in relative to maybe some of your more efficient competitors? And we did get a question in the chat about the join code. I'm going to go ahead and throw up the QR code just in case some of you have to rejoin. So if you scan that QR code, you'll be able to get to these questions, or you can go to minty.com and the code is at the top of the screen. So Jim, it looks like right around 22% strongly agree. About half of the people in the audience say, yeah, they have lower per unit fixed costs relative to their most efficient competitors. And about a quarter of the people, okay, say, well, maybe we're a little bit higher on the fixed cost. Does this surprise you in terms of this distribution?
It doesn't surprise me in terms of the responses, but my first question is, you think about this, is how accurately are you actually computing those fixed unit costs? Are you really computing your fixed cost per bushel of output, for example, of corn and soybeans? Again, as we've worked with a lot of farms over the years, a lot of farms haven't actually done a good job of making that computation. So my first question is, are you really putting the effort in to figure out where you're at there? The second question is, from a longer term standpoint, this is a classic benchmarking question, right?
Yep.
The whole idea of benchmarking is, first of all, to look at how you're performing over time. So track how for example, your per unit fixed cost, your per bushel fixed cost are changing over time. Then the second thing is, as the question kind of implies, always compare yourself to the best, right? Or at least your estimation of what the best might be. And then think about what the best firms in the industry are doing relative to what you're doing. That's really the classic use of benchmarking, is to compare yourself to the best, think about what they're doing versus what you're doing, and how you might be able to change your operation so that you can lower your costs.
Let me explain why we focused on fixed costs rather than some other cost. A lot of producers like to compare seed, fertilizer costs on a per unit basis. We're focusing on that on per unit basis, repair costs and fuel costs. And I'm not saying that's not important. It is important, but in my experience, there's a lot more variability in per unit fixed costs. Here I'm talking about labor costs. There's a lot of difference across farms. And so you want to compare your labor costs per unit to other similar farms. The same with capital costs. Are you calculating machinery investment per acre? Are you calculating machinery cost per acre? If you're not, we have some publications on our website that talks you through how to do that. And so that's why we're focusing on the per unit cost, because those vary tremendously across producers. Another thing I want to point out here is, maybe it's an obvious point, but it's very important to bring this out. Let's say you've invested a lot in machinery because you're thinking that that's going to save labor. We've done that for decades in agriculture. We've bought bigger machines so we can use less labor per acre. Are you calculating both of those costs? If you're spending a lot of money on machinery on a per acre basis, do you have a low labor cost? You better have, because you spent all this money on capital. Because you want to be able to use the same amount of labor for more acres. The proof's in the pudding. And so those two in particular are very important to benchmark and see, where am I at with respect to machinery costs? Where am I at with respect to labor costs? And when I talk about labor costs, you want both operator and hired labor included in there.
So, Michael, I think based on your experience looking at farm records, and Michael Ram, there was a executive director of the Kansas Farm Management Association for many years. There's a huge variance in those machinery costs per acre. You might share the dollar values on that just a little bit.
There's tremendous. Let's talk about machinery investment per acre, anywhere from 500 to excess of $1,500 per acre. And you can make the $1,000 per acre work if you have very low labor costs, but that's my point. You typically want to benchmark those two together.
Yeah.
And labor costs is the same way. For crop farms, for example, I've seen labor account for less than 10% of all costs, all the way to 20%. Well, think about that. That's a lot of difference in labor costs.
And you might just share with them, with respect to, if you're going to try and track labor cost on your farm, you've got some hired labor, but the main component of labor is actually the operator draw against that farm. How do you handle that when you're trying to make those computations?
Well, for operator labor, I like to use the labor draw, and here we're talking full-time farms, and so my occupation is primarily agriculture. So I take a look at that operator withdrawal as the operator labor amount.
Yeah. I think a lot of people
Yeah.
have a tendency to forget that,
Yes.
right? And that's a huge component of those computations if you want to do a good job on it. Brady, let's look at the national numbers.
Yeah. So before we do that, we actually had a question come in that I want to show here real quick.
Okay.
So the question was, in regard to fixed costs, how do we know what our competitors are for comparison?
There is some sources, and these sources tend to focus more on mid-sized farms, I would say. The University of Minnesota FinBin data bank has fixed cost information for about every crop you can think of, every crop and livestock enterprise you can think of. Obviously, the Kansas Farm Management Association, if you're in the plains, that's a very good source of information. If you're more in the Eastern Corn Belt, the University of Illinois also has FBFM. Is there a Farm Management Association? They also publish some information that would be very helpful. And I would encourage you to do this both on a whole farm basis. That's what I was saying. The percent of total expenses by labor is a very quick and dirty number to see where you're at. But also, of course, doing this on an enterprise basis. And the enterprise, if you look at some of the Illinois data, not to belabor this too much, but you've got to be excited here, Brady. I really like this topic. The cost per acre for corn, for example, anywhere from 30 to over 100. I don't need to tell you guys that 100 is probably too much. And so you really need to know where you're at.
So another question that came in, and I think we have time to answer these before we move on because we've got two strategic levers left. What do you include in machinery investment costs? So Michael, I'm going to turn this over to you.
Tractors, combines, discs, whatever you have for machinery. I include everything in there. The difficult part here is if you do have crops and livestock, you have to kind of have to take a look at your total machinery investment. And then you need to decide what percent goes to the livestock and what percent goes to the crop, and then do the calculations accordingly. But I would include everything in there.
Yeah.
You can do a separate calculation for building the grain bins, and so leave those out. But all machinery could be included in there. And you can the best way to do this is probably take your values off your balance sheet.
Yeah, I would also say be very careful about when you're calculating your machinery costs. Do not forget the cost of repairs, maintenance, and the overall cost of ownership of that piece of machinery, right? That's probably something a lot of us underestimate when we're thinking about the true cost of that machinery.
I have been a little bit loosey-goosey here. I apologize for that. Really is two benchmarks. You're talking about crop machinery investment. That's the amount off the balance sheet divided by your acres. And that's what I've been focusing on here. But machinery cost itself, yes, Brady, you want to have machinery ownership in there, repairs, and fuel. Those are the main items that would be in that machinery cost. And again, I'm going to refer to publication I have on the Center for Commercial Agriculture website that goes through an example that takes a look at cost for a case farm and goes through the calculations.
Yeah. And then the other thing I would say, Michael, is on the flip side, definitely think about how that equipment impacts those other levers. If you're buying a piece of equipment, that means you're going to use less fuel or less fertilizer. That's a cash flow back to the ownership cost of, a positive cash flow back to the ownership of that equipment. And we got to be careful. We don't want to overestimate it, but we also don't want to ignore it.
And there is such a thing as too low a machinery investment. If you're running junk, I mean, it's pretty obvious. If you're running junk, that's probably not going to be efficient either. And so there is a possibility to go too far with that. And so everything's a balance when you're talking about these benchmarks.
So we're going to move on for the sake of time. There's some other questions in the chat, and if we have time, we'll come back and get to them because there's some really good questions on investment in machinery in the chat right now. But we want to move on to the balance sheet, thinking about pulling the balance sheet lever and managing your assets. So here we're just going to ask you, do you have a strong balance sheet for your farm? Do you strongly agree, disagree, or strongly disagree with this assessment? So it looks like right now, the strongly agree, most of the people in the room feel that they have a strong balance sheet, with slightly more just saying agree rather than strongly agree. And I'm going to take this one first, and then I'll let Jim and Michael comment on this. This doesn't surprise me at all that this is how you guys feel. If you think about one of my main extension appointments at Purdue University is working with the agricultural lenders in Indiana and the surrounding states. And what I've heard from them when I go talk to them is farmers have some working capital and the equity portion of the balance sheets is pretty strong in agriculture right now. The one comment I'm going to have there is if you think about the word cloud that we put up, right? People are worried about commodity prices. People are worried about the margins that are going to be had here for the 2024 crop season. Thinking about what I call burn rate. So if we expect negative margins or if we expect a downturn in an economy, burn rate is thinking about what's your runway? How long can you last at this lower rate? I think building up what I'm going to call the war chest or the cushion, right? On your balance sheet to say, okay, if 2024, if the worst case scenario in 2024 comes to fruition, how long can I last if that goes through 2024, 2025? I think that's a really important exercise when looking into strategic risk. How can your balance sheet be a buffer for this downturn? That's one thing, especially when I talk to the bankers and I hear with the interest rate argument that some farmers may go to working capital rather than take out a larger loan, maybe on the operating side. I think keeping that war chest as full as possible for maybe a prolonged down period in commodity prices. And just know that's not what I'm predicting. I'm just saying if that were to happen, I think that is a good move on the balance sheet to kind of combat some of this strategic risk.
So just following up with what Brady had to say, if you think about it, it's no big surprise that most of us are coming into 2024 with both a strong balance sheet and a strong working capital position. That's the good news. The bad news is the next couple of years look like both of those are likely to erode, especially the working capital. So the challenge is to make sure you're managing that in a way that you can, in fact, use it, as Brady just said, to kind of weather the storm, because it looks like we're going to have a tough year from a cost return standpoint in 24. 25 might turn out to be a little better than what it looks like right now for 24, but it's probably not going to be a return to what we experienced in 22 or even 23. So the challenge is to manage that and use that for what it's for, which is a buffer, right?
We purposely didn't define strong balance sheet before we had you answer this. And so let's talk a little bit about that. What we had in mind there was a strong current ratio, so certainly liquidity, but also solvency, low solvency, the low debt to asset ratio. And so I wanted to say that. But another point I want to make here, yes, we need liquidity to weather the storm. That's what every business needs liquidity for. But you also need liquidity to take advantage of opportunities. I want to go back to that upside, upside of strategic risk. If all of this stuff's going on and you're in position and other firms are not in position to expand, to take advantage of maybe an opportunity to grow a specialty crop, that's a very good thing. And so think of liquidity as both weathering the storm and being able to respond quickly to a new opportunity.
So looking at the national distribution here, not too much different than
Very
what you
similar.
guys in the room, probably a little bit more on the strongly agree here. I think the question, the question of the day is, what does this question look like if we're going to ask you this time next year, right? Or this time in 2 years? What does this question look like in this room? And I think this is where we get to that war chest and that buffer of making sure that this doesn't swing too far to the right. We did have one question come in to the chat that I want to bring up here real quick. So strong equity, yes. But what they're saying is, but low liquidity is causing a squeeze in financing with banks receding to lessen their risk with low loan to value loans. Would you suggest leveraging equipment equity in the short term? So I'm going to give my opinion here
go ahead, Ray.
first. That equity is going to be there. I don't think that the equipment market is going to soften. That equity is going to be there in the long term. And, while at the beginning of this talk, I said interest rates were just a reversion to more normal interest rates or slightly elevated interest rates, I don't think I would recommend at this point going and using that equity that's there in equipment. I would use that as more of a last resort type of item. Maybe there's something I'm not seeing. So the person who put this question in the chat, happy to talk after, but I would say that this is more of a last resort type of strategy to use that equity, later on and keep that in the equipment right now.
I would concur. with that. And one of the things you got to be very careful, and it goes back to my having liquidity for new opportunities. You don't what just because you have the money to make a huge down payment on a piece of machinery doesn't mean that's the wisest thing to do. And so you always have to think about, do I need this liquidity not only to weather the storm, but for these other purposes? And so you always want to keep that in mind. And also, when you're looking at equity, you really want to draw on that equity when things get really tight.
Yep.
And we don't know the situation of the person that was asking that question, but you don't want to draw on that because you can't draw on that well very long and the water's gone.
So unfortunately, we're running a little short of time, so I want to move on to the last bucket, which is people, which we're going to kind of divide from strategic and people at the same time. So real quick, we asked this question nationally. We're not going to pose it to you guys. Does your farm have established goals, objective, and core values? So one of the things we think it's really important, core values may seem like a pretty trivial thing for a farm to do, but core values can really be a guiding light for how you manage your farm. I think, especially if you think about succession planning in agriculture, if one of your goals as a farmer or farm is to bring on the next generation to the farm and ensure that it's viable with the next generation, making strategic management decisions that lean into that core value, right? And don't shy away from that. And it may be costly. Maybe there's mistakes made, but you're providing a training ground for the next generation. Making sure you're actually managing the farm to that core value and letting it be known and improving that communication, I think, is really important. And that's just one example of why core values are important for the farm.
We're kind of stressing core values because, particularly with respect to succession plans, we've worked with a lot of farms over the years that have said they want to see the farm survive into the next generation, and they imply that that's a core value. But then when we look at the decision-making process that they've gone through and some of the decisions they've made, they've not been true to the core values. So if you haven't thought that through, I'd encourage you to think about it some more and ask yourself, as you're making decisions, if one of your core values is to bring that next generation back into the farm, are you making decisions that are consistent with that core value? Most of us find it easier to talk about things like goals and objectives. I want to reduce my cost per bushel. I have a goal of seeing this business grow at maybe 3 to 5 or 7% per year. Those are a little easier for most of us. It's a little tougher to think about those core values and maybe live those core values on a day-to-day, year-to-year kind of a basis, Michael.
Yeah, and this is difficult because it varies tremendously. It depends on the person that's part of that next generation. And one of the things I talk about with succession planning is transferring management. Well, that's it's difficult because you really have to think about what strengths is that person really bringing to the operation, and how fast can we transfer some management responsibilities to that person. The key thing there is, regardless, don't necessarily ask how fast. Ask what management responsibilities in the short term should we be able to transfer to that person so they start get some experience managing the business.
Yeah. So on the screen right now, we wanted to kind of put you guys, we're talking a little bit about succession and the core values. And we want to see how, if you guys brought the next generation here to this conference, and we realize maybe you answered no because there is no next generation or life circumstances prohibited. So we realize that those are the case. But we just wanted to stress, like, if succession planning is important, maybe not this event, but learning sessions, putting the next generation in the shoes of the current management of the farm is important.
Stated another way, are you allowing that next generation to do some professional development that would enable them to be a successful operator of that farm operation? And if they're not, and if you're not from a farming standpoint, from a farm family standpoint, you need to think about that. How does that next generation get the skills that they're going to need to be successful? Whether it's some of the topics we're talking about here today, it could be technical topics, it could be a variety of different topics, but are they doing that professional development over time that helps them become more successful? Because one of the things this conference really points out is the pace of change in agriculture is accelerating. And if you're not doing professional development on an ongoing basis, you're going to be falling behind. And if that next generation isn't doing it, they're falling behind as well.
Yep. So with that, we are out of time. I just want to remind everyone, for more farm management news and information, Jim mentioned at the beginning that he is the director of the Center for Commercial Ag. If you want to go to our website, purdue.edu/commercial ag, there's a host of information there. We also have a podcast that you can find on that website or any of the podcast providers where we discuss topics like this, but in a podcast format. Go take a listen to that. So with that, we thank you all for listening to us today.
Thank you very much.
Thank you.